360 payments. 11,000 days. That's how long the average person will be tied to the single biggest financial decision they'll ever make. And here's the terrifying part. Most people spend more time choosing a Netflix show than understanding what they're actually signing. Right now, someone just walked out of a bank holding keys to a house they think they own. They don't. Not yet. Not for 30 years. This is the mortgage, and by the end of this video, you'll understand it better than 90% of people who've already signed one. Let me take you back to something you understood perfectly when you were 7 years old. You wanted a treehouse. The ultimate treehouse with a rope ladder, a telescope, maybe even a secret compartment for your treasures. You could see it so clearly in your mind. But there was one massive problem. You had $5 in your piggy bank. The treehouse cost $500. You couldn't build it yourself. You didn't have the tools or the skills. And waiting to save up $500 would take until you were basically too old to enjoy it anymore. So you did what desperate people have done throughout history. You went to someone who had what you needed. Your wealthy friend listened to your proposal. They looked at your drawings, considered the plan, and made you an offer that would change everything. They would give you all $500 right now, today, so you could start building immediately. But nothing is free. You would pay them back $5 every single month for many, many years. And here's the catch. You wouldn't just pay back $500. You'd pay back $700, maybe even $800 by the time the debt was settled. That extra money was the price of having your dream right now instead of waiting for someday. Congratulations. You just learned what a mortgage is. Faster than most adults sitting in a banker's office. Now let's scale this up to the real world, where the treehouse becomes a house with a yard, and your friend becomes a massive bank. The principle stays exactly the same, but the numbers grow teeth and the stakes become life-altering. The average home in America costs around $400,000 right now. Most people don't have $400 in savings, let alone $400,000. Even if you save aggressively and sacrifice vacations and new cars, it would take the average person 20 to 30 years to save enough to buy a house outright. But you need a place to live right now, not in 30 years. Now, while you're young enough to enjoy it, while your kids are still kids, while life is actually happening. This impossible gap is where banks built their empires. They loan you the cash you need immediately, and you spend the next 3 decades paying them back with generous interest on top. Same deal as the treehouse, just with exponentially higher stakes. Here's how it actually works. Let's say you find a house for $400,000. The bank's first requirement sounds reasonable. Put some skin in the game. They want 20% down, which means you need $80,000 in cash. This is money you've saved, proof that you're serious about this commitment. The bank then loans you the remaining $320,000. But remember the treehouse lesson. Nobody loans money out of goodness. The bank wants their money back, plus a thank you fee for taking the risk. This fee is called interest, calculated as a percentage of whatever you still owe. If your rate is 5%, you're paying 5% annually on your remaining balance. Now comes the part that breaks most people's brains. You don't write the bank a check for $320,000 next week. You pay it back in tiny monthly installments over 30 years. 360 separate payments. Each one identical. Each one withdrawn automatically, whether you're ready or not. Your monthly payment might be $2,000. Every month for 30 years, $2,000 flows to the bank. But here's the shocking part. In those early years, almost none of that money actually buys your house. Maybe only $400 of that $2,000 reduces your debt. The other $1,600 is pure interest, pure profit flowing to the bank. Think back to our cookie debt. Imagine owing your friend 10 cookies, and every day you give them 1 cookie plus candy as thanks. In the beginning, you're handing over 1 tiny cookie crumb and a massive pile of candy. That's mostly thank you payment with barely any real debt reduction. But as years pass and you owe fewer cookies, the proportions flip. The candy pile shrinks, and you're finally delivering real cookie portions. By the final years, you're giving almost all cookie and just a sprinkle of candy. This gradual shift is called amortization, and it's why selling your house after 5 years means you've barely made a dent in what you owe. You've been feeding the interest machine while your ownership grew at a glacial pace. But something magical happens if you stick with it. Every payment means you own a bit more of your house. This ownership is called equity, and it accumulates like a snowball rolling down a mountain. Painfully slow at first, then gradually picking up speed. After 10 years, you might own $80,000 of equity. After 20 years, maybe 200,000. And finally, after 30 years of never missing a payment, you send that final check and the house becomes completely yours. No more monthly payments. No more thank you fees. Just you and your fully owned home. It's one of the most powerful feelings in personal finance. Before we go further, I need you to do something. If this explanation is making mortgages finally click, smash that like button. Every like helps this financial education reach someone who desperately needs it, maybe someone about to sign papers without understanding them. Drop a comment telling me what confused you most about mortgages before this video. And if you're serious about understanding money in a way that makes sense, subscribe to Easy Finance right now. We break down everything from credit cards to crypto into explanations so simple your younger self could understand them. Now let's talk about those 30 years, because this is where theory meets brutal reality. Life doesn't pause because you signed a mortgage. You might lose your job. Medical emergencies might drain your savings. Your car might die the same month your roof leaks. And through all this chaos, that mortgage payment still comes due. Every month. No excuses. No mercy. If you can't pay, the bank can take your house through foreclosure. All those years of payments, all that equity, all those memories wiped out. The bank sells the house to recover their money, and you're left with nothing but damaged credit and the scars of losing your home. This is why the mortgage is simultaneously the greatest wealth-building tool and the most dangerous financial weapon. It gives you a home decades before you could afford it. It provides shelter and stability. But it chains you to a payment schedule that lasts longer than most marriages, longer than your kids will live under your roof. Yet here's the beautiful paradox. While you're making payments, that house is also growing in value. Real estate historically appreciates over time. That $400,000 house might be worth $500,000 in a decade, $600,000 in 20 years. So even though you're paying interest, you're also building genuine wealth. You're creating an asset you can pass to your children. This is why experts call mortgages good debt. Unlike borrowing for a vacation or a car that loses value immediately, a mortgage buys something that typically becomes more valuable. You're using someone else's $300,000 to build your own fortune, slowly and patiently, one payment at a time. Most people sign their mortgage in under an hour. Someone slides papers across a desk, highlights where to sign, explains a few numbers. Your head spins with excitement and terror. The numbers blur. The legal language might as well be ancient Greek. And when they ask if you understand, you nod and sign, because everyone does this. Very few people read all of it. Even fewer truly understand what they're agreeing to. The total amount they'll pay over 30 years, which might be double the house's price. The interest rate that multiplies into hundreds of thousands of dollars. The penalties for late payments. It's all there in black and white, and almost nobody reads it. But here's what I want you to understand. A mortgage isn't just buying a house. It's buying time. It's having now what you couldn't have for decades otherwise. And like all deals that let you borrow from your future, it comes with a price. The question isn't whether that price is worth it. The question is whether you understand exactly what you're repaying and whether you're prepared to honor that promise for 30 years. That signature doesn't just purchase property. It purchases a future. And futures are expensive. So before you ever sign a mortgage, arm yourself with understanding. Know what amortization means. Understand how interest front-loads your payments. Calculate the total you'll actually pay over the loan's life. Ask uncomfortable questions. Read the fine print. Make sure this mountain is one you're genuinely prepared to climb. If this video helped you understand mortgages in a way nothing else has, I need you to take action right now. Like this video so more people can find it. Share it with anyone thinking about buying a house. Subscribe to Easy Finance and hit that notification bell because we breaking down every financial concept that banks want to keep complicated. Your financial education is too important to leave to chance. Comment below and tell me what financial topic you want demystified next. Credit scores? Student loans? Investment strategies? I'll create whatever you need most. The mortgage is a promise that spans 11,000 days. Make sure you understand it before you make it, because that promise will shape your life in ways you can't imagine yet. And unlike most promises, this one comes with legally binding consequences that follow you for 3 decades. Welcome to adult financial responsibility. It's terrifying and empowering in equal measure. But now you understand what you're getting into. And that understanding might be the most valuable thing you take away from this video.